Hello and welcome to a bonus episode of Simply Tax, a podcast dedicated to delivering practical and timely content to simplify tax challenges. It's May 27, 2020, and it's not news to say the Paycheck Protection Program, or PPP, has been fast-moving, frequently changing, and seemingly ever-evolving since it came into existence with the enactment of the CARES Act back in what seems like at least a year ago, March 27, 2020. Given that, we're doing something a little different with this episode to help you cut through the static of the PPP world and bringing you an uncut interview with who I'll call the three PPP amigos, BKD's Tad Goodenbour, James Anderson, and Robb Conner. The three gave what I thought was an excellent 90-minute webinar last Monday, May 18, 2020, that took a deep dive into what we know about the loan forgiveness calculation, and we've included a link in the show notes to the archived recording of the presentation so you can check it out, particularly if you're still familiarizing yourself with the ins and outs of the PPP and the forgiveness concepts, as we won't cover them in detail in the conversation today. I called up these PPP gurus to get their take on where things stand after the latest guidance that was released last Friday evening, May 22nd, where we got two new interim final rules, one on loan forgiveness and one on the review procedures and related borrower and lender responsibilities. Let's jump in and get started by learning more about our three PPP amigos, starting with the infamous Tad Goodenbour.
I'm the old guy that Connor keeps referring to every time we have a webinar when he does the total ages of everybody added together, and he always mentions that there's one that has over half. I'm that guy. So I've been here, BKD for, it's probably pushing on, 14, 15 years right now. Came over from Grant Thornton. Been at this thing for, about, getting on to 38, 39 years now. So this is kind of an interesting thing. I've never really had anything like this come up before in terms of, a program that's getting thrown into place with so few rules during such a short period of time, which it really kind of lends into exactly what we do. So other than the timing of it, which was pretty lousy the way it came. I think James will probably say the same thing, and I know Robb as well because we work in the same practice unit. I think between the three of us, during the time period between March and April 15th, we didn't quite get to double digits in returns out the door. But I think we're getting close now. So timing wasn't good, but the response that we've got to the webinars and more importantly, the questions that we've gotten afterwards, kind of all encompassing, is more time afterwards than, getting up, for that weekend before the webinars.
I'm sure. Yeah. Well, and I'll tell you that experience really comes into play here, Tad, in times like these. And even though it's all new and we're figuring it out as we go here, almost, yeah, having at least the background to work with is an important thing. But James, maybe a little bit about yourself before we kind of jump in.
So I'm a tax partner in our Nebraska practice, currently serving as our tax director for the Nebraska practice and then for the North region of our firm as well. And, in our practice, the interesting part of this is we do work with a large number of financial institutions as well. And so even though this, like Tad described, when this became our sole focus at the end of March, and which is unusual during tax season, but when this became our sole focus, not only were we helping clients that were borrowers, but we were interacting with a number of financial institutions that were trying to learn these rules at the same time we were from the lender perspective. And so it was interesting sort of working both sides of that issue and trying to navigate the things that the financial institutions were thinking about as well as the things that borrowers would think about. And I think I just echo Tad's comments that this has been a show of probably patience on the part of some of our clients because our attention was so extremely diverted away from the things that we're normally doing this time of year that oftentimes, while everyone else's lives were turned upside down by the pandemic, after a certain period of time, they're sort of expecting, hey, let's get these tax returns out the door. And, here we are some, month and a half after April 15th. And we're still, getting new guidance every day on this program, which is diverting our attention still. So wearing a lot of hats right now. And I think one of the things I've come to appreciate, I've come to learn Tad's schedule because we've been in communication almost every day. And the thing I appreciate the most is Tad's an hour behind me in terms of time zones. But for some reason, whenever I sign off at night, he's still online. And then in the mornings when I think I'm getting up early to start again, usually the first thing that happens when I turn on my computer is a message from Tad that says, "Good morning. What did we learn last night?" So certainly new times indeed.
Yeah, well, it's great to have others to kind of go through it together with, I guess I'll say. But and maybe speaking of that, Rob, maybe again, a little in your background and the experience of kind of wading through everything that is PPP.
Robb Conner. I'm a tax partner in BKD's Denver office, which is part of the Colorado Springs and Salt Lake City practice unit. I've been with the firm ever since college. I joined in 2005, so puts me about 15 years of experience, and I'm the young pup in the group. I know how many years of experience Tad has because he joined the profession the year that I was born. But really, what draws me to tax is just the amount of information and personal data that we have in serving clients. I mean, if you think about a tax return, what do you see on there? You see when a couple gets married. You see when a couple have children because you add dependents. You see when individuals achieve personal and business financial success. And really on the flip side, you see the opposite. You see the death and divorce and financial failure as well. And because of the fact that we have such access to that information about our clients over the course of serving them become like friends and in certain instances like family to us. And so I will echo what both James and Tad said that back when the CARES Act passed in March, we were in the throes of tax season, but we immediately put down what we were doing to read through the act and pull out provisions that could help our clients continue to pay their people and continue to keep their business alive. And certainly this program was one of the areas that the three of us spent a lot of time on because, well, our clients were impacted by us. Um, Damien, it's I think our paths crossed when we were both serving in the national office together. So it was an enjoyable experience to get to know you through that. And thanks for having us on the podcast today.
For sure. No, I feel I'm the fortunate one here to be kind of hosting you guys on here because yeah, so much experience. So again, maybe with that in mind, let's kind of jump into the loan forgiveness calculation, kind of what we know and obviously what we don't. And I know you guys did a webinar about a week ago here, and so we've had two Friday night late releases of application and instructions, and then obviously the interim final rules this past Friday. So maybe the biggest takeaway, Tad, what were the things that kind of struck you from those releases with that information?
Well, I think when we got the first set there on the 15th, which was actually the application, kind of seemed like we were getting stuff a little bit backwards, application before the rules. But I think I think Rob made the comment on one of the webinars that you can pretty well be assured that the people that were putting the form together and the instructions, were talking to the people who were putting the rules together. So you felt pretty comfortable that what was going to come out with the IFRs, but when we got the IFRs Friday night, I mean, I kind of ran through them first to see if anything really jumped out, and they were pretty consistent, with what we had gotten in the forms instructions. I still feel, and I think James and Rob, I'm not going to speak for them, but I still think we feel that there's a couple of things that need to be corrected in the forms themselves in terms of the calculations, and the IFRs did not do a lot to clarify those particular items. But I have to say, through this whole process, from as we kind of progress and get additional information as we move forward, I've been, I guess, pleasantly surprised at the friendliness of some of these IFRs and rules that are coming out. Probably the biggest one to me is, the dual covered periods that they came out with on payroll versus, some of the other things. But that alternative payroll covered period, not so much in that standpoint, but maybe what the regular covered period will give us. We still feel that that one will give us the ability to get more than 8 weeks worth of payroll. I've had a couple of conversations and with people today if we think that they will fix that, and I don't know that they think they have to. They've had two bites at the apple to fix it. The first one was when the form instructions came out. They could have made it clear there. Or secondly, when the IFRs came out on Friday, they could have fixed it there, and they haven't done it in either one. So I'm cautiously optimistic we're going to still have the ability, and it's all a matter of luck and timing on when your loan proceeds, were deposited compared to when your pay dates are. So a little bit of luck there, but it does present another opportunity.
Yeah, James, what kind of struck you in kind of unpacking this stuff?
Yeah, certainly the items that Tad referred to in terms of the alternative period and some of these other things. One significant one that I think we got some favorable takeaways was just this whole concept of paid or incurred. That was such an area that needed larger guidance issued on, and I think between the interim final rule and the form instructions in the reverse order, that really settled that issue for a lot of people in terms of what costs actually count during the covered period. And we found out, of course, paid or incurred is actually two separate items. Where I think originally some of us were of the belief that paid or incurred was a singular item for purposes of evaluating costs. So that was certainly one fresh item that was a large resolution to some unknowns. And then I think out of this latest IFR guidance that came out on Friday night, the second of the two that really relates to the forgiveness process, we've had so many questions from people asking us, what does this SBA review look like on my loans? And up until this point, and I think still today, we really don't know. I think there's more guidance coming on that. But that was our first glimpse into that the 60-day period that the lender has to review someone's forgiveness does not end the review, and that the SBA has an additional 90 days after that to actually issue the funds back to the lender. And up until that time, we weren't sure if that 60-day period was running concurrently between the SBA and lenders, or whether they were consecutive, and we got some guidance on that as well. And quite frankly, this whole forgiveness concept, everyone keeps asking, we need to model this. Where's the template? We need to get our stuff into the lender. And, one thing to remember is that loan forgiveness application, something that we didn't really realize until the application came out, is there are numbers that you report on that application that are as of June 30th of 2020. And so that seems to indicate that even if our covered period ends prior to June 30th, we likely will not have a significant number of loan forgiveness applications being filed prior to June 30th of this year.
Yeah, no, that's interesting, and maybe again a good level set, I guess, in terms of the expectations, because I know there's a lot of interest, obviously, in understanding this and figuring out what the calculation is going to be and what's the forgiveness amount going to be, but kind of knowing that it's there is still some time here, and perhaps some of these questions will get answered. But yeah, kind of back on the questions, Rob, what really struck you when we got the application and the further guidance on it?
Sure. I joked on both of the webinars that it's a pretty easy process, right? You spend the entire loan, make sure 75% of it was on qualified payroll, don't reduce comp, and don't reduce FTE count. And the quote was, "Wham bam, thank you, Uncle Sam. You just got a tax-free grant from the government." But it wasn't, as we know, that straightforward, and we really needed guidance on a number of areas. And I think, on the 3508 form and the instructions, what they gave us was calculations that, while maybe time consuming because you're looking at a significant amount of payroll data, and especially if you have a lot of employees, the calculations are fairly mechanical. Um, in other words, they gave us clarification on how the FTE reduction works. They gave us clarification on how the 25% comp reduction works. They gave us clarification on how to um, take advantage of safe harbors if you experience either of those reductions, and how to go about restoring those reductions so you're not dinged for it on your loan application. But then, most importantly, in my opinion at least, they gave us an ordering rule for how those reductions are applied. And I think it was very intuitive, and it made a lot of sense to us when you looked at how the calculation was. Your forgiveness amount is limited to the lesser of three. items. Your modified total cost, which is the payroll and the other costs after being reduced by the FTE or salary and wage reduction. That's one of the limiters. The other is the total loan amount. You're not going to get more than the total loan forgiven. And then that third, which is still up for debate in Congress right now, is the fact that if you don't spend 75% of your loan spend on payroll costs, then you could potentially be limited there as well. And the reason I say that's up for debate in Congress right now is because nowhere within the CARES Act was there a reference to the requirement to spend 75% on qualified payroll. So, biggest takeaways for me in summary is uh, this application for forgiveness is going to be time consuming. There's going to be a lot of data gathering, but assuming you can get good data, the actual calculations that go into the application are fairly mechanical.
Knew it was going to be very accountant heavy, I guess, and manual calculation heavy in terms of what goes into it. But that's something that really struck me there, Rob, was there is a lot of a little bit more to it, and then obviously still kind of unpacking that a bit. But maybe with that, Rob, I don't know, did you have anything that surprised you? I know Tad was talking about some of the kind of favorable sides of things. Anything that kind of surprised you in what we've learned so far?
I mean, two things just in conversations with clients who got the loan proceeds are, uh, first they said, this all makes great sense to me. I know that I didn't have a reduction in comp. I know that I didn't reduce my head count. So, why do I have to go through all the exercise of proving it? And I think that the response is, well, because if you look at the worksheets that go with the application, you're required to list out all your employees and the relevant information. And part of that is showing that there wasn't a reduction in average FTEs or a reduction in compensation. And so while you may know that you didn't have either of those factors working against you, you want to make sure that your loan application upon submission is as complete and thorough as possible. So it's going to be necessary to go through that. And then the other, depending on the industry that our clients are in, many of them, you know, look at the restaurant, hospitality, and hotel industry. I mean, they're not able to have their people come back to work, and so right now, one of their biggest costs is rent. And so if we get out to the end of their 8-week coverage period, and they haven't been paying their people, but they're going to bring them back, towards the end to make sure that their FTE reduction doesn't work against them, then they're going to get dinged pretty heavily on the 75% payroll requirement. So uh, that's in my opinion one of the biggest surprises, because it wasn't in the CARES Act, but it's in the guidance that the SBA released. So we got to work within those requirements, and unless they change.
Yeah, yeah. Well, it's been interesting to see how that's almost evolved, and I know Tad. Maybe just on the topic of some of those changes before we maybe get to some of the questions, because I know you mentioned all the questions you've been getting, and I want to hear what some of those are. But what do you think, kind of on the legislative front, and how that's kind of coming into play here? Is that obviously there's the 75%, but then even just the extension perhaps of the covered period. What's your take on that, and what advice would you have for people that are, again, maybe if you want to call it planning for their loan forgiveness amount?
Yeah, I think that's the biggest, concern that I have right now for a lot of our clients and people that were on the webinar is that they're doing things right now under the assumption that I have 8 weeks, to do. And so they might be doing some things that they would not otherwise do in terms of bringing employees back, trying to payroll up, I guess is kind of the new term that, we sort of coined here is, to payroll up during the 8-week time period, for maybe they're maxed out on the 25 and they figure, look, for every dollar of payroll I spend right now, at least I get 33 cents or 33 cents of non-payroll costs, and that's worth it to me because I don't want to run the risk of them not extending the 8 weeks. But I really, like I said, I'm very much of the opinion that they will extend that 8 weeks. I may look, most of our people only need another 2 weeks, another 4 weeks, but they're talking about going out to 18 to 24. I mean, you do something like that, that is significant. I mean, you start paying hero bonuses or something like that right now, geez, you may be leaving some money on the table because that's money you could have used for regular payroll, 10 weeks, 12 weeks, 14 weeks out, from now. So I've just been really cautioning people is that, look, if, at least wait till the end of your 8-week time period before you, start spending money on bonuses or, thinking you have to payroll up at that point in time. You'll be a lot better, we'll know a lot more at that point in time about where the legislation is in connection with this. But, like I've said many times before, if I was a betting man, which I am, I would put a lot of money on the fact that this will be extended. Now, bear in mind, I'm also the guy who put a lot of money on the fact that the expenses would be fully deductible, and this was just some college professor just coming up with a theory that that they would not be deductible. So I'm still eating that crow on that one, but I feel a little bit better about this one. And so we're advising them, look, just don't get in a hurry. What's really kind of ironic, through this whole time period is the people who were kind of waited till the last minute to maybe turn their application in are probably going to be in the best shape. And in terms of at least, they're, 6 weeks beyond, the initial start of this thing. They got 6 weeks under their belt, and there's still money left. So they may be actually in pretty decent shape as they go through it.
Hey, Tad, it's interesting that you brought up, this whole payroll up concept and, people needing to maybe proceed with caution because we don't know what rule changes are still coming. It's interesting if you look at the guidance of the first interim final rule that came out on Friday night this past weekend, that one of the items that is referenced in the preamble to these rules is that the SBA is issuing these rules right now to give people a high certainty or a high degree of certainty on how to maximize their loan forgiveness by rehiring employees or not laying people off during the covered period because they recognize that people are coming to the end of their period. So it is interesting to think that on the one hand, you have this potential action going on in Congress that could change the outcome for people in terms of how they spend this money and what they spend it on and what time periods are available. But even inherent in the rules that we got just some 3 days ago is the notion by SBA that these rules give you so much certainty that you can just proceed.
Yeah, under the assumption that you'd be able to spend all that money in the regular course of business anyway. Okay, and if that's the case, sure, spend it. But where I'm concerned is people who are going out and spending that payroll that they otherwise wouldn't have spent. Worst case is they're not getting any additional non-payroll cost. And best case is, that, okay, I get some additional loan forgiven. I get the payroll into the pockets of my people, but it still cost them the payroll tax cost on that. And if that's not money they're otherwise spending, look, you're either going to give it back to the government, you're going to give it back to your employees with additional payroll tax costs to you. Those are my two choices. Okay, now absent the fact that I might get some non-payroll costs, get payroll tax costs, I'm probably going to wait because I can always spend it right at the end of my 8 weeks if I don't feel at that point that I'm gonna be able to, or that they're not going to extend the 8-week time period. But I just think it's so valuable, that 8 weeks. And if you're not going to make all your payroll tax or your payroll costs anyway, I'm still going to be sitting on it a little bit.
Yeah, it's funny to rewind the clock and think about, we're sitting here in late March, early April, and the, unanimous recommendation was these funds are going to go quick. You better get your application in, and be front of the line so you make sure you get a piece of the first bite. We didn't have any, inkling at that point in time that there would be a second round of funding. But we were chatting a little bit on this before we came online, just about the numbers and at one point I think we were talking it was above 40 some odd thousand loans that were in excess of $2 million. They gave us some borrowers some relief with an FAQ. I think it was FAQ number 46 that said, hey, if in retrospect you didn't make that certification in good faith, you can return your loan proceeds no later than May 18th, and we won't refer you to any prosecuting body. I think the amount of loans, James, what was it now that are in excess of 2 million?
Yeah, so the numbers are actually updated through Friday, and so there's been almost $4.5 million worth of loans issued for a total of just over 510 billion of funding. So there is still room available, as you said. But of those 4.5 million loans, there are, I say only, but there's only 30,000 of them that were over $2 million, which are the loans that would be subject to at least, based on the FAQ, some additional level of review by the SBA. And, it's interesting to note the average loan size now through Friday is down to under $120,000. And so, at the outset of this, we were talking about the complexity of the forgiveness application. And I think we've been speaking with a number of clients and people that listen to the webinar and others that have much larger loans than that are in a pretty good position to get advice from a firm on how to do this. But some of the work they'll be able to do themselves in terms of making these detailed calculations. But if you look at that average loan size being $116,000, and some of those, are companies that obviously are struggling right now to make payroll and pay the costs to stay open. And on top of that, now you have this forgiveness application that is going to put some pretty onerous requirements on those companies to do these calculations. And those are the types of companies that may not have a CFO, or they may not have advisors that have followed the rules as they've come out real time that can assist them. Or certainly, even if they do, they're not maybe in a position to have to spend additional dollars to have somebody help them with these applications. And, if you just look at that average loan size, there are going to be some people that really struggle with this forgiveness process. And I think that's unfortunately going to put some of this back on the financial institution lenders. Because if you look at the other set of IFR that dropped on Friday night this past weekend, those lenders they don't have to redo all the calculations, and they're not certifying the calculations, but they do need to do a high level review of those calculations. And if something doesn't look right in terms of, how the FTEs are calculated or how the wage rates are calculated and some of these things, the onus is on them to put that back to the borrower and basically ask for additional documentation. And I think that's going to put the onus on some of these loans that are, of the average or smaller size. It's going to be a difficult process for them.
Boy, James, I think you just hit the nail on the head there. I've been thinking about this, and it's almost like they need to come out with a 3508 EZ, form for loans under 100,000. And I know all three of us have had conversations after webinars with the guy who owns the local restaurant down in a town of 2,500, which he knows nothing about payroll. He just knows how to fry a good hamburger. And his son or his banker or somebody got him this loan, and and you can tell by the questions that they ask, it's like, this is going to be tough, for him. And you feel for these people because, this is a real lifeline to them. It's a $50,000 loan. It's a $75,000 loan to them, but that's a lot of money. And they're just trying to find out, well, what do I need to do next? And they've never been involved with anything like this. Never been involved with the SBA, never probably even borrowed any money from the bank. And now they've got to go through these calculations of an FTE and an FTE reduction exception. And, we don't even understand this stuff, and you're asking, somebody like this to fill out the form. And you are 100% right, James. These bankers are going to be, they're going to turn into payroll clerks, by the end of the day with a lot of these people. And it's going to be difficult. They do need, I believe, to come out with, a much simpler form for the calculations. Rob talked about, all the mechanical calculations, and they can be tough. And I just think they need to come out with something for some of these smaller borrowers.
Yeah, and what is the time? It's a fairly compressed time frame from when the application for forgiveness is submitted and when the bank's required to make their determination, right? Is it
60 days.
60 days. Yeah, and if you submit an application that's half-baked and the bank can't accept it, I don't know that resets the clock.
Yeah, and Tad's comment makes me think back, Damien, to one of the earlier podcast episodes where you had someone from Tax Twitter on who was talking about how that Tax Twitter community is realizing now that there are people that are paying us to stay on top of these rules every day, and we're consulting with them on a regular basis. But there's a lot of people that just don't have access to that kind of advice. And it's interesting that I think a large number of these $4 million loans are going to be people in that position. And, to Tad's comment, absent some sort of simplification for the smallest of loans, it's going to be a difficult process.
know there's been many questions, and maybe again harking back to your comment earlier, Tad, about the almost the number of questions and answering them taking more time than even getting ready for and participating in that webinar that you guys did last week. But what are some of those top questions, and maybe even as they relate to some of the different sizes of borrowers?
It's kind of interesting, the probably one of the bigger questions that we get, and we try to deflect it in the webinars, is that they all want our opinion about the 2 million. Now that question has been going away, once they came out and kind of took the referral process or the referral to other jurisdictions, off the table. Generally speaking, that's gone away. But probably the biggest question that I am seeing through here gets down to the 75-25 rule, and I think it's probably one of the more misunderstood. Until 2 weeks ago, misunderstood. But a lot of people were thinking, 75% of what? 75% of my loan proceeds, 75% of what I actually, spend, in total on everything. What is it 75% of? I think we got an email, Rob, who is that from? And we got an email from some guy says, look, I think I really got this, this whole loan forgiveness thing, kind of pretty well pegged, and I understand it pretty well. But the thing that I'm having trouble with is this 75% spent on non-payroll items and 25% on payroll. So it was a little bit of, even at that point in time, not quite understanding, what the rules are. But Rob responded very tactfully.
Well,
To
and
that one.
unfortunately, that was after our webinar. So
Let's see who gave that one. Oh, James.
That's right. Yeah, I need to speak more clearly.
Yeah. Yeah. But that was a bigger one of the bigger ones. But I tell you, what we're getting a lot of questions on, disproportionate to probably the number of people who are going to be affected, is this whole FTE thing. FTE and the 25% reduction is, I really think this is going to be a narrow band of people, especially the 25% reduction or more reduction in pay. I think there's going to be very few people, who are going to, actually come under that piece. And we do get a lot of questions on that. And I just don't think that when people go through the calculations, and unfortunately they're going to have to, that this is really, really going to be an issue. But that's probably one of the biggest ones that we get.
I'll say that that's probably one of the most overwhelming, perhaps, aspects of it, to your point, and maybe that, again, going back to you, James, and the amount of legwork that has to happen. But what kind of questions are you seeing and hearing, James?
Yeah, so a couple of things come to mind. I mean, this paid and incurred was certainly some welcome practical guidance that we received a week ago. But I do think that there are still some people that are questioning, and Tad, you referenced it earlier. It seems like under the traditional covered period, the 8-week covered period, not the alternative, there may be an opportunity to get more than 8 weeks worth of payroll into the forgiveness calculation. And I think that's just one right now to proceed with caution on. And we're getting a lot of questions on that. How certain are we on that? And you know, it's not it's not anywhere in any of the rules. It just, by definition, you would be able to, at the front end of your covered period, be able to get potentially another week or two worth of payroll in there. And then on the payroll concept, just because we keep referring, I think on the webcast we said it a number of times that payroll costs are golden here because they drive the majority of the forgiveness calculation. And all of the guidance has really been silent on how do we treat people that are self-insured with respect to their health insurance plan, and in terms of paying claims and claims that maybe are incurred but not paid yet, and how do those things work, and really there's no guidance on any of that. And so I think that's an area that we're getting some questions on. We're getting a lot of questions on how will the review process work. And right now, we got a little inkling into this 60-day and 90-day period, but not much beyond that. And there was some suggestion in these rules on Friday night that, there will be more interim final rules coming. I think now we're up to 15 sets of regulations or interim final rules. So we're obviously going to have more. And then another question that I think comes up often is, even though non-payroll costs are limited to 25% of the forgiveness calculation, seem to be getting a fair number of questions surrounding the interest component in terms of covered mortgages. And we might have some sort of hybrid debt or lines of credit. How are things secured? things of that nature, wondering what interest is going to be considered here. We know that it's covered debt on both personal and real property, but I think some of the finer details surrounding that are things that people are thinking about right now for that 25% piece.
So, Rob, I know a fair number of questions I've been receiving lately have kind of centered around maybe the documentation for the forgiveness, as well as perhaps some of and again, kind of getting to the tactical here, right? And what you need to do, the certifications that we got. So, I don't know, of those areas that you've been getting a lot of questions on your front as well.
Yeah, it's almost as if you were reading my mind because I'm thinking about all the questions and certainly the questions that James and Ted had mentioned are commonplace. But I'd say that the third area of questions are okay. We got the Form 30508, we got the instructions, and we've got these new interim final rules from just this last Friday. What can I be doing now to position myself well for forgiveness? And so, my response is always take some time and read and reread the Form 3508 instructions. And once you've done that, let's schedule some time together to talk through any questions that you may have. And once you've got clarity on the paid and incurred rules, once you've got clarity on the FTE periods that you have to measure, because keep in mind there's like potentially 5 different periods that you have to measure to determine if you have an FTE reduction. uh, once you have a working knowledge of the rules, uh, then start putting together the information now that you can put together. So some of that historical payroll hours and rate data, gather that now. And if you use a payroll company, make sure you're talking to them now and having them develop those customized reports, because some of them are really good about responding to requests for custom reports that'll um, you know streamline the application process. And then really read through the documentation. I think it's page 10 of the Form 3508 instructions. Read through that and start accumulating the documentation that you need to submit in connection with the loan forgiveness application, as well as the information that you need to maintain and not submit, because the more you can do now, the better it's going to be on the actual application process.
James, if there was one or two things in particular that you are most interested in, or you feel like we still have question marks or gray areas around, what would those be?
Yeah, I think there's a couple. Right now we have this concept that the costs that we're paying with these loan proceeds are non-deductible, even though the loan forgiveness is non-taxable. And in some situations, particularly maybe with retirement contributions, you could end up in a position where that cost was deducted actually on a 2019 tax return. And so, what type of tax return amendments might be needing to be filed if all of a sudden the loan forgiveness happens, let's say at the end of 2020, or even maybe it's a lengthier process and the loan forgiveness doesn't happen until 2021. uh, what what process will taxpayers have to go through? It seems like there ought to be an administrative way to deal with that rather than have to go back and amend a large volume of tax returns to get the deductions in the correct year and so forth. So I think that's one thing that we're a little uncertain of right now. Um, I think in the guidance that came out on Friday night, there's probably one discrete issue with respect to employee owners. And so this wouldn't be self employed individuals and it wouldn't be partners. But there's I think, some language that is a little uncertain in the guidance from Friday night that describes what the limit on payroll costs is for employee owners, whether that $15,385 cap, which is the prorated $100,000 for the covered period, whether that is the total cap on payroll costs for them or whether that cap is just the cash compensation and that any retirement and health insurance payments would be on top of that. Maybe for most borrowers that won't be an issue, but for some larger companies, I could see that affecting their calculations, maybe in somewhat of a substantial way. Tad spent a fair amount of time on the webinar talking about some of the restorations to wage levels and FTE headcounts as of June 30. And I think at this point there is some uncertainty as to, what period of time do those levels need to remain in place. If there are further economic situations that arise and those levels dip back down after June 30, what are the implications of that? And then I think a final one that I've been hearing is, what if my cover, there's still money available. And so if a borrower obtains their loan right now, their covered period is going to go well beyond June 30th. And so what are the implications for that on some of these restoration provisions in the wages and FTE counts if June 30 is the date in all of the guidance so far?
Interesting issues, right, James? I don't know, Rob. What would you say? Anything you'd add to that or echo?
Yeah, I mean, I think both Ted and James kind of hinted at this notion of tax deductibility, but for those who didn't spend time with us on the webinars, I think it's important to point out that Treasury is view on things. They put out a notice clarifying that their view is that any expenses that are paid with the tax exempt income aren't deductible, meaning that if your loan is forgiven and you've used that loan to pay for otherwise tax deductible costs, those otherwise tax deductible costs are no longer deductible. Yeah, I have my view on things, and I think it's consistent with these two guys as well, is that if the whole intent of the loan forgiveness was to be tax free, you're kind of being inconsistent with your approach if you don't allow the tax deductions. I mean, this is intended for businesses that have significant economic need, and that stimulus should come not just in the form of tax-free loan forgiveness, but also allow for the deductibility. I think that there's many in Congress that share that same view. However, if the deductions are going to be allowable for these costs, it has to come through legislation, which is, as we know, in this environment, you've got two sides of the aisle that are trying to work on a bipartisan issue, and when they do that, they try to stuff in their own agenda items as well. And so that whether we'll see that anytime soon, who knows? But that's something that we're all paying close attention to. Um, James mentioned the whole limitation on the forgiveness for amounts paid in the form of compensation to owner employees as well as self-employed partners of partnerships or self-employed individuals. And there's this kind of anti-abuse rule that's built in to prevent using loan proceeds from the PPP to inflate compensation during the 8-week period eligible for forgiveness. And you kind of got to look back to 2019 and annualize 8 weeks and figure out what your amount there is. There's nothing that we've seen though, however, that would prohibit an owner of a rental property who leases it to his trade or business that received loan proceeds to use loan proceeds to pay himself rent. So there's no prohibition that we've seen on related party rent. That's something that we're keeping our eyes on. But if they were to have a prohibition on related party rent, I would have at least thought that they would have addressed that either in the form instructions or the Friday interim final rule. So, still unanswered questions. What makes it tough is how frequently the rules seem to be changing and evolving. And so we're trying to do our best as soon as rules do change or evolve to get information out to our clients and ThoughtWare subscribers. So stay tuned for more as things evolve.
For sure. Yeah. One, it's funny you mentioned that and I know we're all runners here on the interview here, but just like you feel like just it's always like a race, and but then it's a marathon that you kind of have to pace yourself, but then you feel like at times you're sprinting, and I mean it is a tough race to pace, I guess is what I'm trying to say. So, Tad, what are those unanswered questions for you that maybe we haven't covered, or maybe you'd add to?
Yeah, I mean, I want to pile on a little bit on this, non-deductibility of the expenses. You by Congress putting in there that it was not the proceeds are not taxable. Okay, I think it's pretty clear what their what their intent is. If it was not, then you're going to try to make the argument that members of Congress, knew about Code Section 265, was actually out there. 95% of us accountants didn't know about 265. And so you're actually kind of trying to make that argument that yes, they did this intentionally. They knew that 265 was out there. No, they had no clue that 265 was out there. And again, I know Treasury was the one that came out with, I believe it was a notice that kind of said that, look, it's non-deductible, but we'll see what happens. I know Secretary Mnuchin has said, look, we're amenable to changing, but we got to have some guidance. So hopefully it doesn't take as long as the qualified improvement property change took, to get resolved, but it may end up doing that. Probably the biggest unanswered question I have, and I've been asking this, all along, doesn't really have a lot to do with, or really doesn't have anything to do with the calculation of the forgiveness. It's it's more dealing with these $2 million people and above. So remember that this is going to go up to the SBA to make the determination whether you met the certifications and all these rules. But my question has always been, what happens if they say you didn't qualify? What kind of rights do you have as a borrower to appeal that decision? Well, that got answered somewhat on the the IFR from last Friday. The one dealing with the lenders and the process, and it said that a borrower actually does have appeal rights, for the determination made by the SBA, but they have not figured out what those rights are. The only thing that they did say, it will be covered in a later IFR. So I think it's a very significant item, because if you had one shot at this, and that is, to have the SBA person, who, and I've made this comment before, who, one of the things they have to determine is the liquidity of the borrower. To them, liquidity means how much coffee they have in their coffee cup, and they've never seen that before. They've worked inside the SBA all their life. They've checked boxes to approve loans, and now they're going to be put in this position, of being an arbiter, which is not a natural position for them. Now, I think the maybe the little asterisk I put by that is that, as James said, there's 30 some million loans out there that are going to have to be looked at. SBA is going to have to bring somebody in. They've got to do something, to try to get this process moved along, because with the staff that they have right now, I mean, that's going to just take forever to get done, I think. So to me, that's a big thing right now for mostly the borrowers over 2 million. Probably if there's anything else, whether, I was looking at the 25% or more reduction in pay correctly, and how the calculation is done on the form, which I don't think corresponds to, what the actual IFR came out with the other day. So hopefully they'll get that resolved too.
Yeah, yeah, it makes it challenging when there's discrepancies like that. But well, maybe bringing the conversation full circle here, Rob. Let's start with you. Some kind of closing, parting thoughts on kind of where we stand and looking forward with this loan forgiveness calculation.
Yep, absolutely. I mean, I'm just going to echo something that I've already said in response to questions we've been getting, is that the more you can do now to start accumulating data and really understanding what needs to be provided in connection with the application, the better. Now, I'll tell you that we BKD have developed a template that can help guide our clients through the mechanical yet complex calculations, but it's really a matter of if you input garbage into the calculation, it's going to spit out garbage. So you can't just view this tool as something that's an easy button, 1, 2, 3, plug in the numbers and it's going to spit out the answer. You really do have to understand some of the more technical items that are needed as inputs. But it, what we're doing with our calculation template is, we will provide it, but there is some level of consulting that we're going to provide to make sure that the folks that are using it understand what they're inputting. So documentation is your friend, and understand what you need to accumulate right now and start working on it.
Well put, James. How about you?
Yeah, I think we hit on this earlier, but just right now, modeling is key. As we've discussed, there are a number of things that we think there should be some clarification on. I think one of the best things that a borrower can do right now is to start modeling out, what does that forgiveness look like? And we referred several times, I think, in the webinar and in some of our other consultations, to what levers might we pull in the last couple of weeks of our covered period if we need to maximize that forgiveness. And so I think right now it's starting with, what are the knowns in terms of payroll costs and non-payroll costs? What are the things that we're pretty certain about? What does that generate for a forgiveness model. And then if we're short, we know there's certain things that we might be uncertain about that we might pull the trigger on in the last week or two of the forgiveness period. And I think that, starting that process now, as Rob suggested, is key, and making sure you understand what might change between now and the end of that covered period so that you have some levers to pull if you need to.
Yeah. Maybe Tad, as I ask kind of your closing thoughts here, and we'll circle back to your betting man comment and kind of where you think things are going there, and yeah, what suggestions you would make or to people that are kind of in that spot of trying to figure out what actions they should be taking, like James was talking about.
Yeah, I think that it really is pretty individual. Everybody's situation is going to be a little bit different, but I think my overall guidance or advice to people is don't get in a hurry. A lot of the stuff that you may be contemplating doing now, you can do 2 days before the end of your 8-week time period. Okay, paying hero bonuses, paying any kind of bonuses to use up your comp. And again, understand the overall effects. But just because you're going to pay some comp and you aren't going to have to pay your loan back, there are other ramifications of doing that. Okay, I mean, does it get you an extra 33 cents of non-payroll costs, or don't you have enough non-payroll costs anyway? So there's a lot of different pushes and pulls that go into the decision about what you're going to do. This is not I mean, this is not rocket science, but it certainly is not a simple calculation. And really, I think people need to reach out, to folks who have kind of been knee deep into this, not to talk our own book, but like I said, I mean, I don't know if I know how to review a tax return at this point in time, versus stuff with the triple P loans that we have here. So reach out to your BKD advisors, or if you don't have one, find one. We have a lot of people who are trained up in this stuff here, but don't necessarily think that you know trying to payroll up here at the end of your 8-week time period is the best course of action. And more importantly, pay attention, to the politics. I know a lot of us, never really have been real political people and following legislation and the process of the House and the Senate. But, I tell you what, I probably spent more time in that stuff than, I mean, I hate to admit it, but James turned me on to what was that thing, James? A hearing with the Inspector General of the Small Business Division, right?
Yeah, it was the preliminary PPP report that
Yeah.
the Inspector General was required to issue to the House Small Business Committee.
I'm watching this. It's an hour and a half long deal. It was actually fairly entertaining, which scares me a little bit, about, what this is turning me into. But again, pay attention, to the politics that are going on, because, very easily, that extra time you spend on it, if you even hear any inkling, they're going to take that out, extend the 8-week time period. Boy, that's going to be huge, huge, huge for a lot of people. I would equate it to the people who had loans under 2 million, who paid them back before the IFR or the Q&A came out, about looking at only loans, over 2 million, and giving a free pass to the ones under 2 million. I would kind of look at it the same way, that if you spend a bunch of money in your 8-week time period, you've left it on the table.
Yeah, Tad, interesting you brought up the OIG because, we listened, I think it was on Friday, May 15th, that report happened. It was the middle of the afternoon, and it was that night that the loan application was released. A couple of interesting notes from that particular report. The Inspector General referenced that the SBA had done 20 years of work in an 8-week period. And I think that's why, we said we're at 15 sets of regulations that have been issued in this area, numerous FAQs. We're almost at 50 FAQs at this point. So certainly the speed in which this was done will necessitate some fixes going forward. But as you suggested, Tad, the political implications of this, they are listening in that committee to what the Inspector General is saying about what is inconsistent with what's being implemented versus what the actual CARES Act said. And I think in particular on the 75-25 rule, it was noted that there would be tens of thousands of borrowers that could not meet that test because they were simply using the funds to try and pay overhead because they're not even open yet, let alone paying employees. And so there were definitely some voices on that House Small Business Committee that were suggesting that that needs to change. And so these reports that are coming out of the oversight division of the SBA could be instructive on what Congress will ultimately do. And one of the things that the Inspector General mentioned during that report was that they have another flash report coming within 50 days that will talk about how the forgiveness provisions are playing out compared to what the CARES Act said. And if you go 15 days from Friday the 15th, that's the 30th. And so we're coming up on that date where we would expect to have another report from the Inspector General that might highlight where there are either consistencies or inconsistencies in what guidance has been released on the forgiveness rules. So, that may continue to provide some additional clarity for us as well.
Yeah, I have to defer to you, James. You're going to have to let me know where to find that stuff. I can find certain stuff in the code and the reg, but that's getting a little bit down there. So
I like it, and I think it's the perspective of all three of you guys is so helpful because it takes so much to keep track of all this stuff, to watch it, to get different ideas, and so I really appreciate you guys taking the time out of your busy schedules. And I don't know, Ted. I think there's one thing I'm going to have to correct. I'm from what you said earlier, and that's that I'm pretty certain that you of all guys know how to review a tax return probably better than most. So other than that, I couldn't agree with what you guys said today more. So.
Yeah, Damien, one thing that comes to mind here, if you go back to our days at the end of 2017, when TICJA was working its way through Congress, all four of us were involved in, having every Friday night when a draft was released. It seemed like during that holiday season, it was always late on a Friday evening that the new guidance or the new draft of a bill or the final bill or whatever stage we were in, it always came on a Friday night. And I think all of us knew that on Saturday morning we were going to be receiving phone calls already. So it kind of turned that holiday season into Friday night reading night to try and stay up on this stuff. And so far, the last 2 weeks, that's proved to be the case again. Friday nights are the time to get up to speed.
And Damien, I got to thank you for turning me on to tax Twitter. So now, I may not appear to be very active on Twitter, but I'm a more passive observer, and so thanks for that.
For sure. No, the tax Twitter community is great. We'll put another plug in there for that, right? It's been there is so much to keep track of, and obviously this is just one sliver of it all. So, but even in this area, it's been particularly helpful. So.
And that's been another benefit to me is that James got me to tweet once.
Look at that. We got Ted tweeting now. This is, things are really changing.
I have 3 followers, the 3 of you.
Well, Damien, you'll have to put up on this podcast Tad's Twitter handle so that we can increase his followership.
Yeah. Anything else here, guys, before we wrap up? I'm still going back to the liquidity comment about the cup of coffee. That was great.
Yeah, but I hope no SBA people listen to your podcast. So,
well, we'll see. We'll see how it goes, right?
You meant it with all due respect, Ted.
That's right.
Of course I did.
Well, thanks, guys. You heard James. Let's get Tad's Twitter followers up. His handle is @Goodenbour, which is spelled TGOODENBOUR. Show notes of this episode are available at bkd.com/simplytax, which is where you can also learn more about our guest today, get an archive of the episodes, and even learn more about me. I'm Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.